Let's get the latest on oil and gold. We'll start off with crude. Our guest says it's more plausible that oil goes down from here with OPEC Plus relentlessly, it seems, increasing production. However, he says the risks of violence in the Middle East and possible disruption to the energy market are probably being underpriced by the market or unfairly discounted. We're joined by Daniel Ghali, Senior Commodity Strategist at TD Securities. Thanks very much for coming on, Daniel.
Yeah, thanks for having me.
So to start off with the bear case, you think it is more plausible that oil goes down from here with this increasing supply from OPEC Plus?
Yeah, for sure. I mean, look, there is only a very narrow path towards significantly higher oil prices, and most paths will probably lead to lower prices from here. And the interesting thing is that I say that even though there's actually quite a bit of positive news coming out of the supply side, right? We're probably close to peak shale production. Venezuelan export permits have been canceled.
By the U.S.
That's right.
You're
yes.
right, yeah.
Right, and that does remove, around 180,000 barrels a day. In fact, probably does help OPEC bring some barrels back to the market. So really, there's quite a few positive things. Even on the demand side, we're not really seeing a significant slowdown in oil demand or even more broadly, commodity demand. So despite this, the really challenging thing for oil prices is that OPEC is undergoing a strategic pivot. Right, we think this isn't a price war, or we're not even close to that, but they are testing shale oil production growth. They are broadening or strengthening OPEC compliance, and as a result of that, especially over the course of the summer months, because seasonally that's a good time to do this, they're going to bring back a significant amount of production.
So you don't think it's a price war by OPEC to try to dissuade other producers?
No, not necessarily a price war, right? I think one of the concerns is that you've had overproduction, under-compliance from Kazakhstan and Iraq in particular. A lot of that is really hard to manage because geopolitically and even just operationally, it's not necessarily in the control of the country. So I don't think this is a price war to bring back OPEC compliance. It perhaps does send a signal to that effect, but it really is probably to test shale oil production growth and to strategically pivot such that if demand does weaken, they do have some levers that they can pull.
There's been talk, and it's not a new theme, that Israel may attack Iran's nuclear facilities.
Yeah.
What could that do to the oil market?
Well, it's funny, a few months ago, most analysts on the street would say that in a scenario like that, oil prices would be trading $10 to $20 a barrel higher. And yet, money manager positioning in oil is at multi-year lows. There's really no sign whatsoever that this is discounted into the oil price. We do think that this is a risk that is underpriced, perhaps rightfully so, simply because it is a difficult thing to position for. But, the way that I would look at it is the right tail in oil prices is probably fat, but the distribution of outcomes is very much skewed to the downside.
I always get, what does that mean, the right tail is fat?
Well, it means that there is a low probability of a high impact event.
Right, such as a widening conflict in the Middle East. Yeah, because Iran could react to, you think, one possibility is they might get their proxies, the Houthis, to attack Saudi oil?
Yeah, I mean, all of this is really unknown, right? There's the potential for Iranian energy infrastructure to be damaged. There's the potential for Iran to retaliate with some of the geopolitical chokeholds that they have on the oil market, or there's even a potential for a war in the Middle East to become more widespread. All of these things could, could unlock energy supply risks that we haven't seen since the 1970s.
Generally, though, you wouldn't be loading into oil right now, piling into oil.
No, because the weighted average probability is that we are headed lower as a result of OPEC's strategic pivot.
Just switching to gold, it sounds like a pretty good environment for gold in that we hear more and more talk of bond investors being wary of both inflation and massive government deficits.
Yeah, absolutely. So I think you cannot have a conversation about financial markets today without talking about government deficits, right? And really, that is at the epicenter of what's happening in gold. I'd say sentiment in gold markets right now is probably pretty bearish. That's a result of the melt up that we've had in prices.
Okay.
And since then, most investors are actually wary of owning gold today.
Okay.
This is the funny thing, right? Gold might be technically overbought, but it's actually underowned. And we think that most of this is a symptom of the fact that the US dollar is partly losing its store of value function. That's a separate discussion than whether or not the US dollar is losing its reserve currency status, but it's partly losing its store of value function. That's happened many times in history, and gold prices are simply a reflection of that.
That's interesting, the distinction between store of value and reserve currency. Could you elaborate a bit on that?
Sure. Well, if you think about U.S. economic history, right, we've had several changes in the monetary order. When the U.S. decided to revalue gold in the early 1930s, that was the first change in the monetary order. Exiting Bretton Woods in the 1970s was the second change in the monetary order. We think we are currently in the third major changing of the monetary order. And the result of that is that, from a flows-based perspective, Western investors are actually underpositioned in gold. Most of the buying activity that has supported this melt up in gold is actually arising from the East, from surplus nations that have a trade surplus with the United States. This is a function of the fact that people are more reluctant to absorb this immense fiscal deficit from the U.S. and really globally.
In particular, China, you mean increasing its gold holdings?
I mean, definitely China is a big participant in that, but it's more widespread, right? If we're talking about central banks specifically, the breadth of central banks that have been buying gold, this has been on a secular uptrend, right? Since 2012, more and more central banks are on the bid in gold. This isn't necessarily a story of the last few years, but what has changed is the magnitude of those purchases. And in fact, we think that what's changed over the last 12 months is that this isn't just a central bank story. It's a story for sovereign wealth funds, for pension funds, for a broadening group of investors that buy gold.
Now, I know you're not a personal finance specialist, and I don't want to, you're not going to stray too far from your area of expertise, but people watching this, should they think, in my portfolio, is it a good idea for just about everybody to have at least a little gold? Or give us your general thoughts on that.
Yeah, I mean, from a portfolio allocation perspective, right, there is a substantial amount of research suggesting that having gold in your portfolio is a positive thing. It's a positive thing because gold tends to be largely uncorrelated with the traditional return streams in your portfolio. And it's a pretty effective inflation hedge as well. So in this market context, I think that's a good idea.
And I've heard it called insurance for your portfolio in part. If all other assets drop, there could be a chance gold goes up.
Yeah, that is up for debate, actually, because
Yeah.
if all other assets drop, gold can sometimes be used for margin calls as well. And that leads to some funky behavior in markets.
Okay.
But generally speaking, I would agree with that, yeah.
Daniel, thank you very much indeed.
Yeah, thanks for having me.
Daniel Ghali, Senior Commodity Strategist at TD Securities. Coming up,